Thank you all for being with us in these unusual times. And Larry, thank you for being with us at La Conférence de Paris for this interview. I would be remiss if I didn't congratulate you, Larry, on, I found out yesterday that Larry, when he started BlackRock, and when he IPO'd it 21 years ago, his market cap was $1 billion. And I found out yesterday it was $102 billion, and made it the third largest financial services market cap in the U.S. I'd be remiss, Larry, if I didn't congratulate you for what you've done. You built an extraordinary company, and that is one hell of a track record, if I may say. And so it's great to have you with us. And
thanks,
you're certainly, well, you're most welcome. Now, as we all know, our lives have changed dramatically in the last year with this COVID crisis. And there's obviously a growing consciousness of our I'd say, human vulnerability. In this context, it's made a big difference in our lives. And if you look at the pre and post-COVID, Larry, what has happened to, in your mind, just social responsible investing?
Well, first of all, Paul, thank you, and thank you for that recognition. I really don't focus on our scale or what we accomplished. All I look at is the trappings of going forward, and so it's about tomorrow. It's not about yesterday for me. And in that question related to COVID and sustainability and how we're evolving, COVID is an existential risk that we're all facing of health. And I think COVID has changed so many lives. And it is very clear that even if we have a vaccination, we will be living with COVID for the rest of humanity. Climate change is very similar. It's an existential risk. We're going to live with it forever. But unlike COVID, where we could reduce the impact by what 90-ish% has been reported yesterday, we are not going to witness that type of change from climate change unless we make some dramatic changes. And I just don't see that dramatic change globally. So climate change is an existential risk. And we do believe that existential risk is changing how we think, how we are acting, how we're going to invest. And it's only the beginning. I wrote in my 2020 CEO letter, these are the type of letters that I've been writing since 2012. The main thrust is about long-term, and I can't think of anything more long-term than the threat of climate change. And every company, every government is going to have to respond. Every human being is going to have to live their lives a little differently. And that's hard to do. It's hard to do that with every government. But what we are witnessing, and this is the beauty of finance, when finance begins to understand a risk, we bring that risk forward. And I think that's what is happening today. We are seeing more investors worldwide focusing on the impact of climate change and how that may impact their investing. And we're seeing a broad scale reallocation of capital. And we're witnessing even the best companies in some of the companies that have issues around sustainability. The best companies in those industries are trading at higher PEs than the ones that are not focused on it. So that's another form of reallocation of capital, just the differentiation between a company who's focused on climate change in an industry and a company that's not. And then we're seeing a real change. Each country has different laws. The laws in the United States, especially under President Trump, where the ERISA laws were fortified, that makes it a little more difficult for us to invest purely on the emotionalism of climate change. We are, as a fiduciary, we must invest where we believe we can maximize return. It is BlackRock's position that climate change is investment risk, and I wrote that. And now we are developing analytics and data to show and prove that. And so from that, Paul, we are beginning to see a tsunami of change, a tsunami of more investors focusing on climate change, even in the United States today. So this is going to be with us. And I do believe we're all going to find ways to adapt and grow with it.
Well, Larry, I'll tell you, one thing seems sure is the numbers are certainly pointing out exactly what you're talking about, because I was looking this up. There's 52 trillion, I gather today, invested globally in SRI. And I happen to know that in Canada, we're 2.8 trillion. And last year, our retail market grew by 25%. I mean, it's a gigantic number. And I wonder if you could give us a world overview or perspective of where this money is and how it's growing around the world, let's say in the different continents, and how you think about it or see it.
As I said, every country has different investments. I mean, the most visible where we're starting to see that is in more renewable energy and wind and solar and hydro. We're using more and more because economically we can substitute hydrocarbons for energy for sustainable means for energy. And I think this is probably the biggest growth area that we're seeing worldwide. We can produce solar energy today cheaper than almost any other form of hydrocarbons. The difficulty, obviously, is storage, and as batteries and other mechanisms for storage is improving, we could do more of that. But most importantly, we probably could minimize and reduce a high-level hydrocarbons as a mechanism for energy, and using solar and other mechanisms for production of electricity alongside hydro, like Canada does so well. But we are also seeing investments in other, in companies within industry, even in the hydrocarbon industry or a cement industry or all the other industries where they're very energy efficient. We are seeing the better companies who are starting to focus on these things. They're trading at higher PEs than companies that are not. So we're seeing large scale of investments in sustainable strategies. Now, some far left organizations don't believe in some of the strategies how we design them, but what we're trying to do is design more and more strategies that can mimic an index, because most investors are their liabilities are generally linked to some form of index. And what we're trying to do is design strategies that are more sustainable with companies that are making the changes more often. And so we're arraying different companies within different industries. Our goal is to become, to perform better than an index. And I'm very pleased to say that 80% of our models that we are designing that are more sustainable than index strategies, those strategies are actually outperforming indexes. And as more and more investors start thinking about it, and this is going to be the big seismic change when this happens, we will then begin to see more and more investors say, I don't want to be in that, let's say, S&P or MSCI index or all that. Can you customize a strategy that shows that you have very close tracking error to the index, because that's what we have been approved about, that you could show us that you're going to outperform, but you're going to have, according to all the metrics, a better sustainable investment criteria across these strategies. As I said, some far left organizations hate this because it's not pure. It is not investing 100% in sustainable strategies. But what they don't understand, we are a fiduciary as an asset advisor. We're not the owner of the money. And what we're trying to do is move more asset owners to more sustainable strategies. And that's just beginning, and I think that's going to be the tsunami of change. And I'm very excited about using more models, more customization, better algorithms to move more investors, as you said, the trillions of dollars, into these more sustainable strategies. And over time, as more money goes into those more customized sustainable strategies, Paul, we're going to see even a bigger delineation for those companies who are just not doing the job that we expect them versus companies in the industries that are doing a better job. And I think that's how we move more capital sooner. I don't believe as a fiduciary, as an asset advisor, I could say to all our investors, get out of all, let's say, hydrocarbons. I wish I could do that, but I would not be, that's not my money. I mean, the money that we manage for so many Canadian organizations, they tell us how to manage their money. What liability do they want? But now what we're trying to do is offer that choice. And through that choice and through the experience of outperformance, through data, through analytics, that's how we're going to move huge pools of capital in the trillions. And we are going to see that then, that really large reallocation of capital.
I think that measured approach makes sense to me, but I wonder, as I think about it, a lot of companies are watching you, and as we speak here, what advice would you give to these companies and how to approach ESG, not just the environmental side of it, but the whole ESG side of it? And I want to quote two people yesterday that struck me. One of them was Stacey Cunningham, who's the president of New York Stock Exchange. She was saying too many companies are staying private because public market demands are onerous. Point one. Point two, sort of to counter that, George Walker of Neuberger Berman was saying how in their due diligence now they're looking at ESG criteria, and now they're linking it to improved company performance. And so there's that juxtaposition, right? The yin and the yang. But how would you tell them to approach it, and how would you go about it if you're advising these companies?
Well, let me just start off with a big macro issue. The biggest macro issue that I see that is a real burden, and I've been talking about this quite loudly, something similar to what Stacey said. Society's putting a lot of pressure on public companies because public companies, by definition, are more transparent than private companies. If we truly want to change the course of climate change, we need to have societal public policy to ask all companies, public and private, to do the same. And as Stacey said, more companies are trying to stay private because it's easier. You don't have that pressure. Well, that's not a good outcome for society. And so with that, we're going to have to focus, or asking all public companies to focus on all their supply chains, which is the phase 3 of climate change reporting. But we're going to have to do things like that. But truly, if we are really serious about this, we have to ask all organizations, all companies. So that's where Stacey is totally correct. Now, as George said, and we fully embrace that, stakeholder capitalism is becoming more and more important. So stakeholder capitalism is about all components of ESG, but stakeholder capitalism is all about focusing on your employees, your clients, the society where you operate. And if you are successful in building a strong culture with your employees, and your employees are willing to work harder for their company, if our clients now, especially more and more young millennials, are focusing on who they do business with more than ever, what products should they buy? Do they believe in that company's products? And so therefore they'll consume with that company. So we're seeing more and more evidence that how you focus on your clients, your message to your clients, has a real impact on your growth. And then 3, in this more of a deglobalization that we're undergoing in the world today, the need to show that you're local, the need, like BlackRock needs to prove in Canada every day we're Canadian and we're American in the US and Mexican in Mexico. If you can't prove that stakeholder capitalism across the 3 major stakeholders, your primary stakeholder, your shareholder, is the biggest beneficiary for long-term profitability. And so in our corporate stewardship, working with, and we have the largest corporate stewardship team reviewing with companies way beyond a proxy. We meet companies throughout the year, and it's not about a proxy season. It's about having a conversation of trying to understand how a company is moving in the long run and how a company is trying to evolve and change with society. Through that effort, though, we're trying to build a better conversation. And so the companies we invest, and we generally invest, 4 to 7% in every company because of our scale, we're trying to help companies move forward. We're trying to help companies understand the demands that we see as an asset advisor from our asset owners. And I believe through that process, the companies that are evolving, the companies that are willing to change, and I can think of some very big companies, hydrocarbon companies that are doing a great job of evolving and changing. Maybe not as fast enough as some far left people believe. But as we said, our number one responsibility is the maximization of profits over the long run. And we do believe through our engagement, our continuous engagement, and through the ability to convince more asset owners about these customizations that we can do on behalf of them for those who are willing to do indexes, we're seeing that change. And so our message to every corporation, if you don't evolve and change rapidly, you're just going to see an underperforming stock, pretty similar to what George is saying, and similar to what Stacy's saying. The pressure on companies is greater than ever before. But I feel that as a public company, I feel just as much pressure from my employees to do the right thing. I can't believe when I was a young kid, I never even dreamed of talking to the CEO. You can't imagine how many emails I get from my employees saying, we must go this way, we must do this. Our employees are engaged. They want to believe in the company that they work in. And more importantly, I get many missives from many of our clients saying we have to move here. And for BlackRock, we are the largest retirement manager in the world. We manage money for red states in the United States and blue states. So we have to work with everybody. And we have to work with, our global footprint where we're in 30 different countries and 100 different offices. So I think it's happening, though, Paul. I think companies are navigating, moving forward, but there's a clear delineation between the companies are willing to be more transparent, more exposed, willing to be reporting about what they're doing. And as you know, in my last year's letter, I asked every company to report under SASB and TCFD. SASB is going to help us understand how a company is performing in the S side more than anything, but also the G and the E. TCFD is really about climate change and how a company is evolving. Since we published that letter in January, there's a 400% increase in companies reporting under SASB. So through that transparency, we're seeing companies move forward, which is fantastic.
Larry, you've got me going now on a lot of ideas here on opening. Let me start with the first one. In what you've said is that we really love it when I hear you say that your people are taking the time to evaluate the companies and not what I get into what I call the tick the box phenomena, which discourages a lot of companies, the sort of one shoe fits all. You were kind of alluding to it earlier as well. It's such a wrong attitude. And I love what you're saying, and I'd love to see you play a role in your industry, mind you, and with institutions, it was possible. I'm thinking mostly, I guess, Canadian pension funds and pension funds in general that tend to tick the box, and I don't think put enough money in evaluating exactly what you're talking about, these companies, and having a discourse with them and interchange with them. So I congratulate you on that, but I'd love you to comment on that. And then I'd like to come back to something else after about what I call the improving class. And let me come to that in a minute, because you touched on it, and I think it's so important. And one of the things Stacy said, by the way, yesterday also, that I think is important, she said, and I totally agree with her, because I remember our group was a bit in that situation. Often people are doing the right thing, literally, because of what you say. Capitalism, and you take care of your employees, you take care of your customers, your community, and everything else. And you're often doing a lot of great things for those people, but you're not talking about them. And you've got to talk about it. You've got to put the investment to talk about these, let them be known, hire the people to help you, also work with the different NGO groups that measure these things. I mean, I discovered a whole new world here, to be honest. And we were just named last year in the 50 top sort of ESG companies in Canada in terms of our CSR. And I was very proud of that because like we were probably at the bottom, not because we're at the bottom, but because we weren't talking about it. So I wonder if you could just touch on those two things.
Well, I think this is where the asset management industry has not done a good job. The asset management job, the typical asset management company has been relying on these proxy advisory firms. Mm-hmm. And as you said, check the box. We took a totally different approach starting in 2012. And then I committed to build the department to it. You know, we have, I think, pretty close to 60 individuals in our proxy team. We had more engagements than any firm last year with companies. So it is my view that if we are going to help companies move forward, it's about engagement. It's about persistence and engagement throughout a year. It is not about whether you're going to do a binary decision, do we agree with management or disagree with management during a proxy vote. Our job is to try to have companies understand where we are prior to the proxy vote, prior to any, publication of proxies, and this is not going to be an issue. And so I believe through that engagement, through more transparency of SASB and TCFD and in greater disclosures by companies, this allows us to be more interactive with a company, more engaged with a company. And a company then, through that transparency, can connect even deeper with their clients and deeper with their employees. And you really do see, I mean, when, we're able to, we have conversations with almost every company in the world. And Paul, there is a huge spread between good companies and bad companies. There's actually even a bigger spread between good companies and great companies. And there are just very few great companies, a lot of good companies. And there are, unfortunately, a lot of mediocre companies where either the management is afraid to show courage, to be transparent, to make that change. And their boards are generally what I would call not doing their job in terms of engagement with their management team. And so, unfortunately, you do see a lot of companies that are just floating along. And those are and that's where I think this real large reallocation of capital is going to occur. It's going to occur. You're going to see the higher PEs, as exactly what George Walker said, for those companies that are engaged. And you're going to see the companies that are underperforming are going to have lower Ps. I can tell you in every industry, you're seeing a gap between the leader or leaders than the peers. I can say in the asset management industry, I mean, we don't have a big universe of public asset managers, but the gap between our PE and the rest of the industry is as large as it's ever been. But you see that in every industry. And this is, again, another form of reallocation of capital.
Well, I'm really glad you're showing the way on this, Larry, because I think it's so important to those 60 people you have, in my mind, are crucial in your enterprise. Only 60, but they're important because I think we've got to get away from this tick the box thing if we're going to be effective in helping people change. Which brings me to the other. Sorry.
Let me just say one thing for everybody who's listening.
Yeah.
If whoever's listening is an asset owner, demand from your asset advisors, that they are not checking the box. Demand it's your money, making sure that they're actively engaged. I actually believe the problem is not with the asset advisors, the asset manager, it's with the owners. They're not putting enough pressure on the advisors to do the right thing. And there's a huge differentiation between those companies that are fully engaged with the companies they own, and there are most companies just use the ISS or Glass Lewis and check the box.
Right. You're right. You're right. You're so right. And it frustrates me to no end. So I'm really glad to hear you on this. We're on the same page, I can tell you, after years of frustration on this thing. And I can tell you as an owner, I certainly haven't minced my words and certainly talked to them about it. I want to talk about another subject now that you opened the door on, which I thought was also sort of a little groundbreaking in my view in terms of the image that sometimes people have on this thing being too black and white. And I call it the improvers. I think there should be a medal for the improvers. And sometimes, some people are in an industry that's an easy industry and that lends itself to it. Mine does, financial services, and I'm improving, mind you, and at this point, getting some awards. So I'm quite proud of that. But it's quite different. I sat on the board of Total for 15 years and the board of Lafarge Holcim now for 15 years or close to that. And let me just talk about Lafarge Holcim for a minute, because here's a company that in a tough industry, I mean, in terms of the polluting aspect of it. And they are working, I should say, like mad to improve their thing. They're winning all the awards now in their industry. They're leading the way. They're even creating ecological cement. I mean, they're putting R&D in it. It's a big investment. There's a lot of R&D going on for their kilns and what they're burning, and helping communities get rid of certain things that, they should be getting rid of by burning them at high temperatures. And so, they're doing so well. And it is so discouraging because we have, close to 100,000 employees. And we care about employees. We care about our customers. We care about the regions that work in. And they're improving. So how do you measure those people, and how do you sort of not get into a situation? The oil industry is another one, I mentioned Total. You listened to Pouyanné yesterday. It's a revolution what he's done. He's changed, as he says, from an oil company and just looking for oil to now an energy company. He's going to be 50% gas, 15% renewables. I mean, he's really making incredible strides. And as he says, I get it. And so what's your message to those people? And we're going to have to end on this.
So I spent a lot of time talking to Patrick, and Patrick does get it. Patrick's upfront. He's transparent about it. He's trying to evolve and change. My conversations, I learn a lot from working with Patrick, because Patrick tells me when I'm wrong. So it's a perfect relationship, because obviously he's an expert in the energy industry, as I'm not. But it is about that. Total is a great example in a tough industry, the evolution of what's going on, doing the right thing, moving the company forward, and is trading at a higher P than some of its peers. Lafarge is the same thing. I mean, to me, those are great examples in very difficult industries where leaders and their board are moving forward. Total is a very good example of an energy company that in a sustainable index where we're trying to closely approximate an index, when you have to pick the best of the industry, we may own a Total above and own any other energy company because of their performance. So on an ESG score, they do better than anyone else in the industry. Now, for the environmental groups, they don't want us to own any. That's just not a responsible way of investing at this time, as we know. Hopefully, we get everybody moving towards that, and then it evolves and moves forward, and over the long run, this changes. But I believe when you see companies doing very well, you see that long-term performance, you see that in their earning, their PE ratios. Investors are willing to give them a higher PE ratio because of their stakeholder capitalism, the way they're moving forward, and how they're trying to reshape their company in a different industry. And I can tell you, I've been talking to many leaders of the energy and different commodity industries, and they have a tough future ahead as we are seeing society making more demands faster. But let's be clear, and I just want to end it with this point. If we are going to have a real sustainable future as a world, we need economic growth. If we don't have economic growth, we're going to move back to coal. And this is one thing that is really important, making sure that we have economic growth. in this populist world that we're living in, making sure we're creating jobs. At the same time, we're destroying jobs, but we're creating jobs that are better than the ones we're destroying. And so we can't just disrupt and stop everything in the hydrocarbon world. That just is not that is not politically acceptable, and nor is it economically acceptable. Now, some environmentalists may harshly disagree with what I just said, but I believe we need economic growth. And the power of economic growth is what is going to power a faster, sustainable world.
Larry, I can't tell you how much I enjoyed this interview and how important that last statement you made is. I think it's uplifting. I think it's right. You have a balanced approach and you have a transitional approach. And if we're going to make it and get more people on board, we're going to have to do exactly what you're saying. And so I really enjoyed it. I think we've come to the end of our time for this interview. I hope everybody else enjoyed it as much as I did.